Hello, welcome back to the continuing lecture in investments. Um, so we're now moving on to a new topic today, and the new today's new topic that's starting today is bond portfolio management. Now, we already talked about, bond valuation previously, and before we did stock, right? So, um, this topic, the bond portfolio management, um, includes a lot of advanced uh, concepts in the bond. So, and it also requires, the foundation in uh, calculus. I mean, even if you don't, um, and even if you don't have, uh, even if you haven't taken any calculus yet, um, but if you have, it still requires not very deep uh, understanding of calculus, but uh, some understanding of calculus is still necessary. It's crucial, and ideally, uh, calculus is a prerequisite to this course. It will be like Math 301, but that's, ideally, as I said, it's ideally, right? That's ideal situation, but the reality, uh, dictates that the best I can hope for is, Math 206, that you have taken Math 206 before, pre-calc, before coming to this course. But if you have taken, if it is at least, a core requisite, but 2 year, and if you're a FIN major, financial management major, Math 301 is part of the curriculum. So by the time you have come to Finance 300, um, you would have either already taken Math 301, or you would be concurrently taking Math 301. So that will, at least if you are concurrently taking calculus, that would still be ideal. I mean, it's less than ideal. Ideal situation is calculus being a prerequisite. But as I said, that's not the reality. But anyway, without getting, mired too much with the whether you have taken calculus or not, we'll have to get going with whatever it takes. So the first thing we would like to do is revisiting interest rate risk. Now, you remember interest rate risk goes by many different other names. First, it's also called price risk, because why is it called price risk? Because interest rate fluctuations directly affect price. And if interest rate goes up suddenly and unexpectedly, it affects the price of your bond holdings adversely. I mean, anything, any asset, when interest rate goes up, stocks also get, slammed, right? When interest rate goes up suddenly, why? Because the uh, discount rate is going up, right? Discount rate. So that's why it's also called price risk, and it's also called maturity risk. Why? What does maturity have to do with it? I mean, price getting slammed by a sudden um, increase in interest rate. What about maturity? Well, I've been telling you, we also talked about this in bond valuation. Um, the longer the maturity, right, the greater the chance of interest rate fluctuation, unexpected, right? Um, the longer the maturity, there are more chances of unexpected interest rate fluctuations, right? Hence, it's called also maturity risk. Now, and interest rate risk is something like inflation risk. Inflation risk and interest rate risk, they both come from macroeconomic system. In other words, it's systemic, right? It's not specific to uh, individual bonds or assets, right? Um, Inflation and interest rate changes are systemic. It's coming from the system, and you cannot. I mean, there should be a way to uh, compensate for these risks. First of all, they always, in the cost of capital, they always, factor in um, expected inflation, right, as a buffer for um, inflation. Um, but is there a way to factor in the interest rate fluctuations? Not Yes, but not exactly directly into the interest rate itself. I mean, think about it. Uh, in a way, uh, the bond issuer bond issuer wouldn't have to worry about the shock in interest rate, right? Because if suddenly uh, I mean, from the borrower's perspective, from the bond, issuer's perspective, um, they pay the interest they pay is coupon interest, and coupon interest is basically all fixed, right? Coupon interest is you lock into a coupon interest. So no matter what uh, the market interest rate may be, prevailing market interest rate may be, it's not really uh, their concern. It's from the investor's perspective. In other words, the bondholder's perspective, right? The risk is, so there isn't much, from the bondholder's perspective, there isn't much they can do about the interest rate shock. They can do something like, interest rate swap, or some type of insurance. But from bondholders' perspective, what you can do as a bondholder is to forecast the interest rate movement and take you, necessary actions to make of to prevent the loss of your bond holding value of your bond holdings, and predict how much how much loss, how much your value of the bond holding would go down, and take necessary measure to make up for that. Right? That's from the bondholder's perspective. That's what you can do. But so basically, we need to understand how the bond price changes with regard to the fluctuation in interest rate. And an economist named Mulkill, Burton Markell. He was Canadian, I believe, Canadian economist. And in 1962, he came up with Mulkill's theorem, which is basically a list of summary of 5 relationships between the bond price and interest rate. Of course, theorem number 1, is called Mulkill's theorem number 1. Bond price, that's bond price, and yield. You understand what yield means now. I mean, in general, yield to maturity is simply another name for market interest rate, right? Why? Because for a particular class of bond, or AAA, double A, single A, triple B, for each risk class, the average of what these bonds in each class pay in return, that's the average market rate for that class, right? That's the it's not the and I don't want to go back to the very basic rationale behind it at this point, because this is something we have already we have done so far. In bond, in Finance 100 and in bond valuation, we already talked about why yield is another name for average market rate. So, and it cannot be, there cannot be just one, average market rate, because for class AAA class, right, it would be the average rate would be, average rate for AAA cannot be the same thing as average rate for AA or triple B or single A, right? They're all different. It's like in Hollywood, the actors like Brad Pitt, George Clooney, Tom Cruise. There's a certain Ben Affleck. I mean, there's a certain league. I mean, these guys would be you cannot compare Ben Affleck with the league of the actors, who are, I mean, this is very, you might think this is a shallow comparison. But I'm just using uh, for example. Of course, in among the support roles like Danny DeVito. I mean, there the actors, the names that I just um, the names that I just picked were um, the names of very handsome, good-looking male actors, right? And they would usually get the leading role, right? And the guys like Danny DeVito or uh, Joe Pesci, I mean, not very, obviously not very, good-looking actors. Uh, they are good actors, definitely. I mean, they make as much money, I believe, because their acting skill or their acting is, very mature. But what I'm saying is, if you compare Ben Affleck, or to who are you going to compare that Ben Affleck with? Um, what's you would compare him with someone like um, Brad Pitt or Tom Cruise or George Clooney or people in that league, right? You cannot compare him with Joe Pesci or Danny DeVito. Or, um, so in other words, for the actors, like they have top class actors and support role actors and um, just extras, um, and the money they are making would be obviously different. You cannot compare the annual income of actors like George Clooney with someone who plays just the full guy um, or an extra, right? So in other words, average of you know that group, right, should be used as a reference point or benchmark. You cannot use average of what uh, first class uh, leading role um, actors make, right? You cannot use the average of that as the benchmark for someone who uh, plays a minor role in the movie, right? So that's why yield to maturity is uh, another name for average market return. Because when I say average market return, that means the market return specific for that class, for that risk class, right? And it's another name for market interest rate, and it is nothing new. We already um, it's given that there is an inverse relationship between the bond price and interest rate. And however, when interest rate goes up, uh, the change in the bond price, increase in yield results in uh, change in the bond price that is smaller than, less than change in the bond price due to uh, decrease in yield to maturity of equal magnitude. That's Mal-Kil's theorem number two, which means it's asymmetrical, right? When yield um, and yield to maturity goes down, of course, then price will have to go up, and that change in price is greater when even if it's the same 1% drop or 5% drop or 5% increase in yield to maturity, right? When the interest rate goes down 5%, the change in price, price will go up. That change in price will be greater than the change in price when interest rate goes up. So when interest rate goes up, the price will go down. So the change in price will be negative, right? The change in price will be negative. And then change in price will be positive in this case. So even for the same, change in interest rate, right? 5%, 5%, right? So it's asymmetrical. And you can, from here, right, you can tell, look at, curve D, let's take a look at D, right? We have, three cases of, curves, they all represent, inverse relationship, right? But let's take a look at, curve D. Coupon rate is 3%. What about curve B? Coupon rate is 12%, very high coupon, right? Low coupon, D has low coupon. And then initial yield to maturity is like 10%. But, either D or whatever you see, right? The horizontal axis is the percentage point, change in yield to maturity by percentage point, right? So if the yield to maturity drops, right, let's say it dropped 5%, right? How about then how much change do you see? I mean, let's say 4%, right? 4%. The increase in percentage change in bond price is almost, right? For just 4% drop in look at this, for just 4% change, right? The percentage change in bond price is like 100%. Bond B, look at bond B. How much okay, that's a positive increase, right? What about when interest rate goes up like by 4%? For the same magnitude, look at what's happening to it's not easy. The for bond D, the drop in price is almost like 40%, right? Please bear with me. This takes a lot of time and it's not easy. And what about bond B, right? This is B, right? And you can tell, I mean, I don't have to draw it with dot all the way there, but you can tell it's about 25% at best, right? 25. So when the interest rate goes up, by same magnitude, right? Both, 4%, 4%, right? But price change in price is asymmetrical. Okay, and that's Malkiel's theorem number 2. Malkiel's theorem number 3 is also price of the long-term bonds tend to be more sensitive to change in yield than the price of the short-term bonds. So let's take a look at the same coupon but short-term and long-term, right? Bond A, they have same coupon rate. A and B have same coupon rate of 12%. Bond A and bond B, right? Same coupon rate of 12%. But one is short-term. The other one is long-term, right? And starting from 10%, if the yield falls to if yield falls 4% percentage point, then that will be at 6%. If yield is 6%, right? Bond A, which is short term, right? Price goes up. For a 4% drop, price goes up about, that looks like about 10%, right? Whereas for bond B, which is, that looks like about 10%. And whereas bond B goes up by about 50% for, so why is the then long-term bond more, and also let's take a look at the case of, when they go down, when the interest rate goes up. When interest rate goes up by 4%, bond A drops, which is short-term bond, only about, looks like, about 5%, but bond B drops by about 25%, right? Looks like almost 25 negative, right? So long-term bond is clearly more, sensitive than short-term bond, which is Malkiel's, theorem number 3. And the reason, just intuitively, is because the coupons work effectively to yield a higher return, right? This means, right? Higher return. Now think about it. just intuitively, right? If long-term bonds, 30-year bonds have a lot of coupons, right? A lot of coupons. And then uh, uh, when interest rate goes down, think, and this interest rate is basically the discount rate. So all of those coupons, and the coupons are good, 12%. It's not 3%. I mean, even if it is 3%, still the same logic will apply. But um, these good coupons will be discounted less, right? With lower discount rate, it gets discounted less, so it ends up in a greater present value, right? So when interest rate goes down, all of those coupons, to receive over a long, like 30 years, not just 5 years, over 30 years, all these coupons weigh in, right? All these coupons weigh in a lot, right? That's how. Um, and when interest rate goes up, those coupons are discounted uh, more heavily. If they are discounted more heavily, obviously it's going to pull down the price, right? And the long term would make it go down more because a lot of those future cash flows are discounted uh, deeply, right? Discounted more, right? And you have a lot, your value, your bonds present value depends a lot on those coupons, right? And those coupons get discounted more deeply, right? Hence, uh, it's going to be, right? Uh, uh, Ending up in a smaller present value. Um, and if it is, if the maturity is short term, right, there aren't that many, coupons to be discounted, right? So it doesn't affect, it definitely pulls down the price, but it doesn't, this affect it as severely as long-term bonds. Okay, um, that's Malkiel's theorem number 3. Um, Uh, we are one more thing. We're out of time actually, but let me explain. Uh, something. Now, if you look at the horizontal axis and the uh, vertical axis, you will see that it's in different units. Why? Uh, Change in yield to maturity is in percentage point, whereas price changes in percentage. You understand the difference between percentage point and percentage, right? Percentage point is between 5% and 10%, right? How much? What's the difference? I mean, if uh, if interest rate went up from 5% to 10%, the changes, right? How much did it change in percentage points, the change is 5%, right? Change is 5%. But in percentage, right? In percent, the change is 100%. Isn't that right? If the return, think about it. If the return on your investment was 5%, right? If the ROI changed from 5% to 10%, right? Then the change in terms of percentage, it's 100% increase, right? 100% change. And percentage point is just 5%. You understand? So the change in yield to maturity is in percentage points. From 10%, it dropped to dropped 1%, 2%, 3%, 4%, and it went up 1%, 2%, 3%, 4%, but it's percentage points, right? Not in percent, not percent. And then from 5 to 10%, if it goes up, that's like 100%. Make sense? All righty. So that's it for this video. I will see you guys in the next video. Stop recording.